Welcome back to Strictly Money. I'm here with Bart Melek of TD Securities. Bart, in light of the economy, let's talk about some of the base metals like copper. What's your outlook?
Well, we think for now, copper probably continues to trend a little lower here. As we've said before, recession fears and perhaps China doing not as well as we had hoped ultimately means that the premium that was given to copper prices a few months ago may unwind. We think there's probably about 7 to 10% too much value in copper relative to the fundamentals, and we wouldn't at all be surprised to see long positions unwind here a little bit more, and that means probably lower prices here. Long term, we like copper. We like it quite a lot. But when I say long term, that likely means beyond 24, 25. For now, it's a little tricky. But anytime you have fears of recession, you should expect commodity prices and base metals in particular to correct here. Though I will, put a caveat under all this. $8,000 or so is still a very, very, very good price. And if this is as worse as it gets, we think it gets a little worse. During a recession, you're in pretty good shape, particularly when the world recovers and fundamentals tighten up.
And Bart, I wanted to ask you, copper, nickel, just in response to the growing demand for renewable energy and electric vehicles, I would think that the long-term fundamentals look good?
Absolutely. Look, we are, I think, increasingly seeing major governments around the world, led by the United States now with the Inflation Reduction Act, committing to transition into a net zero economy. We'll see if we can do it in the time frames that we would like. But the reality here is that metals like copper, nickel, lithium, cobalt, even aluminum are all going to be very much required for that transition. The issue continues to be that when you look at our schedules under the Paris Accord to achieve the goals that we want over the periods that we want, there simply is not enough investment to generate, given the current state of technology, the sufficient quantities of these metals to achieve our goals. So this transition could very well be a little slower. But what does it mean? Well, it means that this demand will be chasing limited supply. And that means prices could very well go significantly higher over the next few years than I think anyone would likely expect. In order to incentivize capital to flow into these risky ventures, which are increasingly chasing depleting ore bodies, which are in inhospitable places environmentally in the world. They're high up in the mountains with limited water resources, lack of roads or electric infrastructure. The costs are going to rise, and that is going to be necessary in order to supply sufficient amount of these metals to have this transition going. And if governments stay true to policy and keep giving a lot of money towards these projects, then I think the future from copper and all metals that are associated with electrification globally will do very, very well.
It'll be interesting, Bart, because on one hand, the rising cost of raw materials doesn't bode well for vehicles when we're trying to keep the prices down, aren't we? Bart, we have a minute left to commercial break. Let's talk about gold. Interesting because record high inflation, and yet we haven't really seen a major reaction in gold until maybe more recently.
Well, look, gold has done very, very well. It outperformed pretty much all other major asset classes over the last 6 months, at least. We've hit a high of, I think, 2058. Very recently, we've come off of late. Ultimately, we do think gold does better. We're expecting gold to trade around the 2100 level by by year end in the last 3 months on average. That means we could see even higher prices. Reason here is we expect the Federal Reserve to pivot into a more dovish policy stance in the latter part of the year. And that will likely happen before inflation is at the 2% target. So that will raise all sorts of questions on the part of investors of how serious the Federal Reserve may very well be about their target. And that means real rates could very well be lower than many had expected.